This is a warehouse receipt. It's also something that helped spawn a $10 trillion industry, the ETF industry. To put things in perspective, $10 trillion is around 40% of US GDP. How did warehouses create a product that helps people retire early? Let's dive into the mechanics of an ETF. I'll walk you through how you'd create the simplest of ETFs. Let's say a stock exchange has two companies, Apple and Banana. There are 100 shares of Apple valued at $2 each. There's also 100 shares of Banana at $4 each. In other words, the market thinks Apple is worth $200 and Banana is worth $400. You want to track the average share price of both companies because you think putting your eggs in two baskets is less risky than having them in one basket. So you start an ETF. Imagine your ETF as a warehouse. Now, your warehouse can't trade on the stock market directly, so you strike a deal with a bank. You tell the bank, go buy 10 shares of Apple and 10 shares of Banana. Deliver them to me. In exchange, I'll give you 10 tickets. You can buy and sell the tickets on the open market. You can also redeem the tickets with me. Because there's 10 tickets, I'll give you 10% of whatever's in the warehouse for every ticket you redeem, which is an Apple stock and a Banana stock. Want me to send you a brand new ticket? Just give me the equivalent in individual stocks. A ticket is really an ETF share. Right now, a ticket is worth $6 because it's one share of Apple and Banana each. The bank will now sell ETF shares on the open market. Individual investors can buy and resell them. Note that instead of buying Apple and Banana separately, you can just buy an ETF share. It's nice when a stock exchange has two stocks, and super convenient when there's hundreds or thousands of stocks. And how did this bright idea come about? Nathan Mose came up with the idea in 1988. He had worked at the Pacific Commodities Exchange. When traders sell commodities, they typically don't ship them out. Doing so can be costly, especially when the same commodity is bought and sold hundreds of times. Instead, the seller hands the buyer the warehouse receipt, and the receipt is analogous to the ETF share. When you buy or sell ETFs, the individual stocks stay in the warehouse. The ETF company doesn't incur any transaction costs. In fact, it doesn't even know who you are. This is partly why ETFs have been cost-effective options for investors, especially in the 1990s where stock trading costs were high. But how do ETF prices stay in sync with stock prices? It's good to know how ETFs work if you plan on pouring your life savings in them. So let's go deeper into the weeds. ETF pricing works like stock pricing. As a simple example, let's say buyers and sellers are lining up to trade the ETF you've created. I've ranked the buyers by their willingness to pay, and the sellers by the price they'd be willing to sell. Some buyers will pay $6, while some sellers will accept $6. So the ETF would be sold for $6. Then no more trades will occur, and the last traded price would be recorded as $6. Let's say another buyer willing to pay $6.01 comes in. Then the price goes up to $6.01. If even more buyers enter, the price could rise to $7. At this point, the bank can say, hey, the prices are out of whack. I can sell the ETF stock for $7 and buy an Apple stock and a Banana stock for $6. Then I'll put those stocks in the warehouse and get back one ETF stock, and I've got a handsome profit of $1. This process is called arbitrage, and the bank will keep doing this until the price gap disappears or until the price gap exceeds transaction costs. Profit opportunities like this pop up frequently, so banks enjoy working with ETF companies. In fact, ETFs will often have multiple banks willing to serve them, even though ETFs don't pay banks. It's an elegant win-win situation. When banks make a profit, they keep ETF prices in sync with stock prices. Before Nathan Most created the ETF, investors wanting to track the market generally relied on mutual funds. That is, funds that pooled investors' money and made investments on their behalf. Investors can only sell their shares to the mutual fund itself. In the basic version of a mutual fund, the fund has to sell its holdings when an investor makes a redemption. If the holdings were sold for higher than their cost price, the fund incurs capital gains. Potentially, everyone may be liable for capital gains taxes. However, when an investor sells their ETF shares, the fund doesn't have to sell its holdings. All the holdings remain in the warehouse, so the other investors don't generally incur capital gains taxes. And what's in it for the warehouse? I mean ETF company? Each ETF has an expense ratio. It's analogous to the fees and charges you see in a warehouse receipt. An ETF's expense ratio is public, so you can find it on their website. Let's say the expense ratio is 0.0365% per year. In other words, 0.0001% per day. Which means every night, the ETF company gets to take out this amount from the fund. So if the underlying stock prices don't change, the ETF price will decrease very slightly daily. Historically, decreases on this scale are generally not a cause for concern. Many popular ETFs return at least 7% a year on average, which is 200 times that amount. Let's say a new company called Cherry enters the stock market. If the ETF tracks the market, it can sell some of its Apple and banana stock and buy some Cherry stock. This reduces the downside of either Apple or banana going bust. Indeed, ETFs that track the stock market have a good record of yielding positive returns. I say good record as there's no guarantee of positive returns, even if it tracks an entire economy for a long time. For example, Japan's stock index is still below its 1989 peak. Japanese companies aren't as valuable now as they were back then. I mean, people don't think that they are as valuable as they were. If this continues, the Japanese stock market will never recover. And that's why tracking the market isn't synonymous with making a profit. Are you thinking of investing in an ETF focused on a single country? Do weigh its benefits against the benefits of a globally diversified portfolio. Take the US as an example. The US market has outperformed global stocks over the past few decades. However, changes in a global world order occur around once a century. The US has been the world leader since the 1940s. At its core, an ETF is amazingly simple. Yet Nathan Most took 5 years to launch the first ETF, mainly because US regulators rejected the idea multiple times. And Nathan Most never saw any royalties from his invention. He wasn't motivated by money. But if he got a 0.01% royalty every year, that would be $1 billion this year alone. What's in this $10 trillion market? There's ETFs that passively track the stock market, as we saw in our simple example. There's also bond ETFs, which are ETFs that buy bonds instead of stocks. Commodity ETFs, which hold things like gold and oil. There's probably an ETF for almost every asset class under the sun. There's even active ETFs that try to outperform the market by trying to pick market-beating stocks. And so on. Since arbitrage is what makes ETFs work, ETFs tend to perform very well in liquid markets. In other words, markets where assets can be bought or sold easily and cheaply. They perform less well in markets with illiquid assets. The arbitrage mechanism doesn't work well there. What if you still want to buy an ETF that holds illiquid assets? Check whether the ETF is currently trading at a big premium. In other words, is the ETF share selling for much more than the value of the underlying holdings? This is far from a comprehensive coverage of ETFs. There are many nuances, but this is a solid base for anyone looking to add a few more branches with further reading. I hope you've learned a lot about ETFs, an industry that's around 40% of US GDP, and an experience in one area can help you design world-changing products in another. Finally, this video is a tribute to Nathan Mose. Thanks for joining me in it. The ETF's humble inventor deserves some recognition for all the work he did.